In the last class, we tried to understand what is the financial system, the reasons why it existed, and what are the various components of this particular financial system. We have financial institutions, we have financial instruments, we have financial markets. Today, we will be trying to understand these particular financial markets, the components of this particular financial markets. I said that the financial market is being divided or can be divided into two different markets. One is called the money market and other one is the capital market. In today's lecture, I'll be giving an information or insight about what is financial markets, what is money market, what are the various instruments that are existing in this particular market. Let us first understand what this particular money market is all about. The money market is a market for the short-term funds with maturities ranging from 1 night to 1 year. I'm repeating, this is a market wherein the short-term funds are borrowed and lent with maturities ranging from 1 night to 1 year, which includes instruments that are close money substitutes. It may not be cash that is going to be lent. It might be a financial instrument which might be lent, borrowed, or used to take funds from the other party. According to the Crowther, the money market is a collective name given to the various firms and institutions that deal with various grades of near money. It is not specifying that it is cash, it is near money. The term money market is actually a misnomer. Money or currency is not bought and sold in this market, but it is borrowed and lent for a short period of time. This apart, the money market is not confined to any particular place. Money market transactions do not take place at a particular place, but usually takes place through internet, telephone, fax, or other electronic channels of communication spaced across the world. However, a geographical name may be given to a money market according to its prominence, which has got over a period of time. For example, we have a robust money market in Mumbai. We have robust money market in London. We have robust money market in New York. That's why we call it the Mumbai money market, London money market, New York money market. Nowadays it is also Singapore money market. So these particular places have come into prominence because of the size of transactions that are taking place on a day, every minute, every second through the various channels of communication. That is the reason these particular markets get some prominence, and because of that we call them as, we attach the money market with that particular location. Let us now understand what are the various features of this particular money market. The money market is purely related to short-term funds. It deals with short tenor paper ranging from 1 day to 1 year. This market mostly rests on the financial assets, which can be converted easily into cash without much diminution in value. For example, if you are going to buy a bond, usually there will not be any loss. There will not be any risk. If you are buying a fixed deposit, you will not usually make losses unless until that particular bank itself is going to collapse. That is going to be a rare case actually in the modern world. Mostly these lenders and the borrowers deal directly in this particular money market without any intermediaries or dealers to save time and money. The money market is not a homogeneous market. It comprises of various sub-markets which are specialized in one category of finance. It might be a treasury bill market, bills market, it might be a term market. We are going to see them later. So the government, the central bank, the financial institutions and the commercial banks dominate this particular market. Usually the money markets are going to be useful for the government for its own operations. It will be useful for the corporates because they will be lending and borrowing on an everyday basis because they require working capital. So the banks, the financial institutions, the central banks and the governments usually are going to be there in this particular market doing their business on a day-to-day basis. So what is this basic, why should this particular market exist really in Spain? Really, in reality? Firstly, this particular market helps governments, corporates and the financial institution in managing their working capital needs to bring about equilibrium between surpluses and the shortfall of the funds available at any particular moment of time. Either the government might be facing shortage of funds, or the corporate might be finding shortage of funds, or a financial institution might be finding difficult at a particular day. They like to go to a certain other person, borrow that particular funds. This is where they go. They go to the money market and borrow some funds. There might be other cases wherein this government or the corporate or the individuals or the financial institution might be finding that they have more than their requirement on a particular day. So they have more funds with them and than their present needs. So they wanted to deploy this particular funds rather than keeping their funds idle, to make some margin out of this particular funds. So they pump out this particular funds. So these markets actually help them in balancing the needs of the borrowers and the savers. Secondly, it enables borrowers and the lenders of short-term funds to fulfill their borrowings and investment needs to make the markets efficient, so that the interest rates are going to balance themselves actually. These particular markets actually help in keeping the flows, keeping the interest rates at an equilibrium rate. Otherwise, if you don't have this particular the money market, what happens? You'll be finding a different interest rate at Bombay, you'll be finding different interest rate at Hyderabad, you'll be finding different interest rate at Chennai. Because of the mechanisms that are created in the money market, because of the continuous flows of money across the borders, within the country and across the world, we will be finding that the interest rates are not going to suddenly shoot up or come down, and the surpluses surpluses which are there will smoothly move to the areas where there is a deficit. So this helps indirectly the economic development of any country. Thirdly, this particular markets provides an avenue for the central banks to intervene into the market whenever it needs, because there is another fellow to buy that particular thing. Supposing that there is a shortfall of money in the money supply. For example, in the COVID times actually, every central bank wanted to pump in more money into the market because they wanted to create demand. You call it as an artificial or reality. Actually, we have to create the need. We have to create demand. So every central bank has started pumping money into the market. How it will be possible for the central banks to pump in more money? If they are going to buy the various instruments that are there in the money market, indirectly which are there with the financial institutions, with the banks, the instruments will go to the central bank and the money will come to this particular banks, and the money which are there with the banks will go into the market actually. So within a short period of time, you will be finding that because of this particular intervention, the money is moving to the public actually in the form of loans. So this particular transmission is possible with this existence of the money market. On the other hand, there is a reverse mechanism is also going to be applied, wherein they wanted to squeeze the money out. So then what happens? They will sell the instruments and they might force the public to buy that particular instruments or the institutions to buy that particular instruments. Then what happens? The instruments, the banks will pay the Reserve Bank of India, and the instruments will come down to will flow to this particular financial institutions. Money will automatically squeezed. So the money is moving from the financial institutions or the banks to the central bank. So automatically liquidity in the market is going to come down. This particular transmission is very much required, and it is going to be an ongoing process in any economy, because unless until they wanted to keep the liquidity alive, there should not be any surpluses, there should not be, at the same time there should not be any shortage of the funds. So that is the aim of any central bank actually. To do that, to help the central banks in managing this particular liquidity, actually these particular money markets are very useful. So interventions are possible only if you have vibrant money market with big number of institutions participating, with wide number of instruments available in the market. Then this money, the interventions are going to be very smooth and very fast. So these are the various functions of the money market. This being the various features of the money market, what is the measurement to understand the maturity of this particular money markets? When do we call this particular money markets to be having maturity? Are these particular markets strong, weak, strong, or semi-strong? So the markets usually need to be very strong. As I said, the central bank's intervention is very much successful only when the markets are going to be mature. We'll be understanding about the open market operations when I discuss about the RBI and the credit controls, which are going to be implemented by the various central banks. What do we mean by this particular maturity of the money market? The measure of the money market liquidity stands the reason to call a particular market strong or a weak market. The measure of the liquidity which is the primary component to understand whether the market is mature or not mature, depends on the market's, the tightness, the depth and the resilience. I am using three different components, three different words. One is called the tightness, the depth, and the other one is resilience. The tightness refers to the divergence between the transacted price and the average market price. The tightness refers to the divergence between the transacted price and the average market price. High, low. That is, if somebody is selling a particular bond at 91 rupees 50 paise, there might be another seller, there should be another seller who is ready to buy this particular thing with a difference of only 5 rupees. Then we call it as highly liquid market. But if you find that one fellow is quoting a particular bond with a particular tenure, with a particular coupon rate at 91 rupees 50 paise, and other fellow is quoting only 80 rupees to buy, that means there is a wide gap. Then we find that there is a tightness in the market. The demanders and the suppliers' size is different. Then there will be tightness in the market. There is another word which I used, that is called depth. Depth denotes the volume of trade possible at a particular time without affecting the prevailing market price. That is, if I am going to sell 1 billion worth bonds, wanted to sell 1 billion worth bonds in a particular market at 10 o'clock, if that size is going to come into the market, then the supply might be too huge for that particular market to accept. If that is the case, the price of the bond is going to crash. The price of the bonds, other bonds also will crash. So the market itself is going to crash if I am going to pump in more bonds into the market to be sold. So the depth, if the size is too big, and even if I am able to, even if I am going to bring in 1 billion worth of bonds to the market to sell, and if the price changes are not going to happen much, and if the volatility before I bring in this particular size of the bonds to the market and after I bring into this particular market, if the volatility is not going to be much, I consider that particular market to be having a higher depth and a higher maturity. Then I also used a word which is called resilience. Resilience refers to the speed with which the price information moves wide apart, resulting from dissipated trade, or speed with which the imbalances in various submarkets are quietly adjusted. I am repeating, resilience refers to the speed with which the price information moves from one segment, one market to the other market, one market, submarket to the other market. If the speed is very good and the price discovery is going to happen very quickly, that particular market is considered to be having higher resilience, and that particular market will be considered to be mature. So we need to understand, whenever we are talking about any market, whether it is a capital market or any a money market, we need to understand the tightness of the market, we need to understand about the depth of the market, we need to understand about the resilience of the market. There are various measures to understand this particular tightness, the depth and the resilience, and there are specific actually measures to understand this particular the depth, the tightness and the resilience. We'll be discussing about them at a later date. Yeah. Now, what are the various institutions which are going to be there in this particular markets? Which are the usual institutions which participate in this particular market? As I said, the central bank, the governments, the central bank, central governments, state governments, municipal corporations, the banks, the financial institutions, the thrift institutions, insurance institutions, even today the mutual funds, and the various other financial institutions actually participate in this particular market. These particular institutions either borrow or lend for a very, very short period of time, and we can call all these particular institutions as the participants for this particular market. Now, coming to this particular money market, there are specific instruments which are there, which only will be there in this particular market. What are the different instruments which are there in this particular money market? We have the call money market, we have bill market, we have the treasury bill market, we have the term market. We have different kinds of markets which are there earlier. But apart from this particular markets, sub-markets, we have various new markets which have come up recently because of the growing needs of this particular market. So let us discuss one component or one instrument of the other to understand how, as a borrower, how, as a lender, we can interact with these particular instruments, when we can use these particular instruments, and what is the purpose of using these particular instruments. And we will be trying to understand the various dimensions of a particular instrument or a particular market which is going to be there in this particular money market. The first one is called the call money market. It is one of the sub-market of the money market. What is this particular call money market? Call money market is the overnight market dealing with temporary funds. I'm repeating, call money market is the overnight market dealing with temporary funds. It is a market wherein money is borrowed and lent for a period of 2 to 14 days. The peculiarity of this market is that it works without any collateral, usually. By phone call, a particular A bank who is in need of the funds call up other bank and ask for 1 crore accommodation. And what do you mean by accommodation? They wanted that particular money. So the A bank talks to the B bank to deposit them with 1 crore for 2 days or 3 days or 1 week or 14 days. And there might be cases wherein the other bank might be saying that at any short period of time, I want that particular money back. You should be in a position to pay back that particular money. And this particular banker might be accepting that particular term wherein he will be saying that I'll be ready to accommodate you back when you require the funds. So this is what is called a call money market. So there might be banks, there are financial institutions, there are going to be insurance companies which will be, or even money market, money money market mutual funds which are going to be there in this particular market dealing on a everyday basis. They might be having, one institution might be having more funds, other institution might be having excess funds, but they cannot lend it for over a period of time. They cannot lend it for more than 14 days, but they have the surplus. So they are going to use the money, this particular money, to get some return on these funds available with them. So this is what is called a call money market. Apart from this particular market, we have something called the Treasury bill market. What is a Treasury bills market? The Treasury bills market is a market wherein Treasury bills are bought and sold. Treasury bills are the promissory notes issued by central bank on behalf of the government, usually for government purposes. It is for government purposes. For example, in India, the RBI, on behalf of the government of India, issues this particular bonds to the various financial institutions. Nowadays, they are even issuing this particular treasury bills to any individual. These are considered to be short-term instruments which are considered to be highly liquid and virtually risk-free, because these are going to be the instruments issued by RBI on behalf of the government. Usually it is going to have zero risk. These are the most liquid instruments after cash and the call money market, money, because at any moment of time you can go to a banker or other financial institution and get a loan on this particular thing. So you can get the funds very easily if you have this particular bonds in your hand. So who is the issuer? The Reserve Bank of India acts as a banker to the government and issues this particular bonds. The purpose of this particular bonds is to meet the requirements or short-term requirements of the government of India. It may be government of India, it might be the government of America, it can be any other government. But the purpose of issuing any treasury bill is to accommodate any government for a short purpose, and it is going to be done. The process is going to be handled usually by the central bank of any country. What is this particular T-bill actually? We are calling actually. The T-bill or the treasury bill is issued either in the form of a promissory note or credited to investors the subsidiary general ledger account. In simple, it is nothing but a promissory note issued by the government of India, issued by the Reserve Bank of India on behalf of the government of India or any other government. So in India, it is going to be the Reserve Bank of India, which acts as a banker, which issues this particular treasury bill to somebody. The size of this particular bill is going to be usually large, and the minimum amount of any treasury bill will be around 25,000 rupees. And it can be, you can buy 2, you can buy 3, and it can be in the multiples of 25,000 only or more than that. And what will be the yield on this particular bill? Actually, what is the treasury bill give you? For example, the treasury bill might be 65 days treasury bill. So the tenor is 365 days. There is what is called coupon rate. And the treasury bill, for example, it is going to be for 20, the nominal value of this particular instrument is going to be 25,000, which we call as face value or the nominal value of this particular treasury bill. And this particular treasury bill is going to be sold at a discount, saying that they are not going to specify the coupon rate, but they are going to this particular bill is going to be sold at a discount. Supposing that they are issuing for the bill for 25,000, you are going to pay only 23,500 rupees. What is the difference? At the end of the period is over, you are going to get back 25,000, though you have bought it for 23,000. So this extra money is what we are going to get in the form of interest when you are buying this particular thing. So you will be having a calculation. You might be interested in finding out the yield for that particular thing. And yield varies with the yield depends upon the face value and the discounted rate. You have to calculate that particular yield whenever you are buying that any treasury bill. So this is what is called a treasury bill. So what are the different kinds of treasury bills you have in India? Actually, the treasury bills are issued for, as I said, for a very short period of time, and we have three types of treasury bills at the present. We have 91 days treasury bills, we have 182 days treasury bills, we have 365 days treasury bills, and they come in the form of ad hoc treasury bills and ways and means advances treasury bills. Ad hoc treasury bills are issued in favor of RBI when government needs cash. These bills are purchased by RBI at a discount. The ways and means advances is not a permanent source of finance. Government, when it is in deficit, but the RBI will extend the advances to the central bank and the state governments to tide over the temporary or short-term finance requirements which need to be repaid in 3 months. So there are different kinds of treasury bills called as ad hoc treasury bills or ways and means treasury bills, ways and means advances. For this purpose, actually they are going to issue different kinds of treasury bills like 91 days treasury bills, 182 days treasury bills and 365 days treasury bills. And usually there is a lot of liquidity, there is ample chance for you to get the accommodation whenever you are going to have this particular treasury bills. That is the purpose why most of the banks and the financial institutions will be interested in buying this treasury bills whenever they have surpluses in hand. So they don't want to keep this particular cash idle. So whenever they have this particular surplus funds, they buy this particular RBI bonds, the government bonds through RBI, so that at any moment of time, if there is a need for more and more cash, they can liquidate this particular treasury bills. They can either go to the Reserve Bank of India and ask them to fund this particular treasury bills, or go to some other financial institution to get the funding on this particular by pledging this particular treasury bills. This is one type of market, treasury bill market. We call it as a treasury bill market, where treasury bills are bought and sold or borrowed and lent. It can be anything, because I am going to give secondary already issued bonds are there. I am going to go to another bank and get some accommodation, that is I am borrowing on the treasury bills which I have. Or I can directly go to the RBI and buying the treasury bills for the first time. I am buying that particular treasury bills. Okay, I can go to some other bank and say that I wanted to sell off this particular treasury bill permanently. The treasury bill market is a market wherein the borrowing or lending is going to take place, or buying and selling of this particular securities are going to take place. Now let us go to the another market or another instrument which is available in this particular money market. This particular instrument is called the certificate of deposit. The certificate of deposit is an instrument issued by the scheduled commercial banks and selected all India financial institutions which are permitted by RBI. These CADs actually are the negotiable instruments which are sold at a discount and sold at a discount to face value, and yield will be more than the coupon rate. And usually these particular certificates of deposits are going to be issued for a minimum period of 7 days or to a maximum period of 1 year. And because a banker is issuing this particular document, or a financial institution is issuing a document, the corporates will be interested in buying these particular things whenever they have more funds to park their funds. They use these particular instruments to get some return on this particular instrument, and this particular instruments can be liquidated very easily because it is being issued. These are being issued by a banker or a financial institution which is authorized by the Reserve Bank of India. Basically, and usually these particular CDs are in the form of a smaller denomination. Usually 1 unit might be for 1 lakh. So usually any corporate which is having 10 lakhs or 5 lakhs who wanted to park their funds for a short period of time, say for 7 days or 1 month or 1 year, they might be going for this particular CDs, and they'll buy this particular CDs and keep it. So the banker is getting the funds because they wanted money, they wanted liquidity, so they issue this particular bonds, the deposits. This is what is called certificate of deposits, and the corporates will be in a position to park their funds with this particular banks whenever they buy this particular certificate of deposits. In the same way, we have another type of instrument. This particular instrument is not issued by the commercial banks nor the financial institutions, but these are the instruments which are issued by the corporates entities in India. This is what is called the commercial paper. So the commercial paper is issued in the form of a promissory note sold directly to the issuer or an investor, or else placed by a borrower through agents such as merchant banks and security houses. These were issued for the first time in the year 1990. So who is the issuer? The companies, the corporates, all India financial institutions. And these are issued, these companies will issue this particular instruments which are considered to be a promissory note. It will be in the form of a promissory note, and the institutions, the individuals, institutions and other individuals or other non-corporate or corporate bodies will be buying these particular instruments. Usually here also the maturity period of this particular commercial paper is going to be anywhere between 7 days and 1 year, and usually the CPs are issued with a denomination of 5 lakhs or multiples thereof. So this particular paper is another instrument which is being used by the corporates to borrow funds for a short period of time to satisfy their needs with regard to the working capital. These particular commercial papers are going to be used by the corporates. Now, there is, apart from this particular CDs market and CPs market, we have another market which is what is called bill financing market, or it is also called commercial bills market. A commercial, what do you mean by commercial bill? A commercial bill is an instrument which arises out of genuine trade transaction. Somebody is selling something. Instead of other party paying the cash, he is giving a promissory note in the form of a bill saying that I'll be paying that particular money after 3 years. That is actually what is happening here. A buyer sends the bill to the other party and he signs on the document. That is, an order is made by this seller to the buyer, and the buyer is signing the document stating that I'll be paying the money on this particular bill after 3 months or 6 months or 45 days or 80 days or 90 days. The tenure may be anything less than 1 year. So there are various kinds of commercial bills which are there in the market. We have demand and usance bills, clean and documentary bills, inland and foreign bills, export and import bills, indigenous bills, accommodation and supply bills. Each market, each geographical area came out with various customary bills to accommodate their own businesses, actually, accommodate their own needs. These particular bills have come into the operation. So on the basis of the acceptance, actually, for example, the hundis have come, actually. So there are different kinds of bills which are there, actually, which are there in the market, which are accepted in the market, actually. This is a big market, actually. There are discounting houses also, which are there, wherein these particular bills are going to be discounted. Because within these 3 months of the bill, I want some funds. I sold some goods to some other party, and other party has signed a bill, but I have a bill. I cannot wait up to 3 months. I don't have time. I want money right now. I will go to some other banker or some other discount house to discount this particular bill. So there is what is called bill discounting. So when you have the discounting houses, more and more banks coming forward to discount the bills, this particular market actually grows. But actually this particular market in reality has not developed much in India, because the bills which are signed by the various individuals are not considered to be genuine in reality. That's the reason actually the banks did not are not interested much in discounting these bills because of the credit risk involved with these bills. So the bill in specific actually is having a character of a negotiable it is having a negotiability, and it has a face value, it has a time period, and it is there is going to be a drawer, the drawee, and there might be another person who is going to pay that particular thing, who is called pay. It is an instrument in writing. It must contain an order to pay and not a request. If you are going to request, it becomes it is not a request, it is a condition. It is an order to pay. A bill of exchange cannot be drawn as to be payable conditionally. The sum payable must be certain. The person to whom the direction is given or whom the payment is made must be certain. So there are different, and it must be signed by the drawer and presented to the drawee for acceptance. The order to pay should be legal tender money. So there are various conditions attached to the format of this particular bill as per the Negotiable Instruments Act. So we need to understand about, if you wanted to understand much more on this particular topic, we need to understand you have to go to the Negotiable Instruments Act and try to understand more about this particular bill market or bill. Now, apart from this particular call money market, the treasury bill market, CDs market, CPs market, and the bills market, which are considered to be orthodox instruments which were there over a period of time. Nowadays, we are also finding some new instruments coming up in the market. The repos, 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 is another instrument which has come, another market which has come. Repo is, in short, sale for repurchase agreement. Repo is short for sale and repurchase agreement, where one party agrees to sell bonds or other financial instruments to another party with an agreement to repurchase equivalent securities in the future under a formal legal agreement. I am repeating, a repo, in short, is for sale and repurchase agreement. I am going to sell you an instrument, and at the same time I agree to buy back that particular instrument at a later date, where one party agrees to sell bond or other financial instrument to another party with an agreement to repurchase equivalent securities at a later date. This is what is called repo. This is a beautiful instrument which has come up over a period of time in the money market. The size of the money market has gone up because of this particular repo market. And the repos are the most sought after instruments in the money market and most used instrument by the central bank over a period of time, any central bank over a period of time. Whenever they wanted to intervene in the market, they are using this particular repos. So what is happening in the repo actually? There is an institution, say State Bank of India or Central Bank of India. Central Bank of India has some instruments, financial instruments. It will go to this market, go to this State Bank of India saying that I have 1,000 crores worth instruments, financial instruments. You buy from me and give me that money. At a later date, after 3 months, I'll buy back that particular instruments from you and give you the return, give you the money back. So the rate at which this particular instruments are indirectly pledged is decided by the central bank nowadays in India. And whenever the banks are finding more cash or less cash, they'll be using either repos or reverse repos. What is a reverse repo? A reverse repo is a mirror image of a repo and represents acquisition of a security with a simultaneous commitment to resell. So repo is a situation wherein I am selling you the instrument with an agreement to buy back. Here in the reverse repo, I am trying to purchase with an intention or an agreement to sell you that particular instrument at a later date. So this is a most sought after instrument in the money market nowadays, and most of the banks and the financial institutions and the central banks are using this particular repos and reverse repos to accommodate their requirements or help to tide over the tightness or the shortfall of the funds or surpluses. And repos is a beautiful instrument, and every student, I feel that every student should understand much more on this particular repos. And this apart, what are the other instruments you have? What are the other other institutions which are there in the market, this particular money market? There are different new instruments which are coming every day in this particular money market world over. We have nowadays the what is called interest derivatives, for example. Interest derivatives is another instrument which is being used to lessen the risk with regard to the interest rates in the money market. We have which is also related to the money market. We have the money market mutual funds which have come up in the recent past, which are indirectly buying and selling the various instruments in the money market. Actually, various earlier we used to find equity mutual funds, debt mutual funds, bond mutual funds, and hybrid mutual funds, but we have now today the money market mutual funds also, which are being floated by the various mutual fund authorities actually, and which is also helping us in creating needed depth in the market. And this is all you need to know about the money market and the money market institutions and the money market instruments. Thank you. And one need to understand that the money market doesn't have any place. It is not constrained to one place. You are part of this particular money market, and you are buying the various, you are putting your money in a savings deposit. You are actually buying an instrument in the money market. You are buying a fixed deposit with a tenor less than 1 year. It is a part of money market. You don't think that you are not part of this particular money market. You are part of this particular money market. You are using already the money market instrument. That is what you need to understand more about this particular money market. Thank you. We'll look into the next aspect, that is what is called the capital market, tomorrow. And before that, I'll be definitely going to the Indian money market and how it works, what are the different instruments which are there, and what that RBI does, how it interacts, how it intervenes in the markets. And this is a beautiful subject, and every student needs to understand much more about the economy. Thank you.